To our featured guest of the morning. Jeff Weniger is head of equity strategy at WisdomTree, and he joins us from Chicago. Jeff, welcome back to the show. It's great to have you here. It's been a while, so we appreciate you making some time early in the morning Chicago time for us today. What's your best forecast, Jeff, as to where the Fed is going? Will there be another rate hike this year?
Well, if they do have one, it's seemingly in line with consensus. Maybe they want to get into a situation where it's pause hike, as opposed to the old 75 basis point ratcheting up maneuvers that we had to get used to for a while. But at this point, the street is starting to think maybe we'll get some of the first indications of cuts, maybe in late spring, maybe into summer of 24. I mean, they went boldly and aggressively. I mean, we're talking about 550 basis points, or I guess 525 basis points over the course of about 18 months. I hope they know what they're doing, Paul.
You've been tracking for some time now the effect of higher interest rates on, among other things, the U.S. housing market. You've written something recently on delinquencies in banks books. That's the last thing that investors, certainly in regional banks, would want to hear, that delinquencies are going to rise. What's your take, Jeff, on the higher debt burden being experienced by many U.S. consumers and banking clients?
Well, and the issue had been when SVB and Signature went under, which was really only 6 months ago, Paul. It was the losses on longer dated treasuries. It wasn't that you read insolvencies or anything like that in your commercial lending portfolio. But that may be something that arises next. I mean, you start to get into a situation where, okay, you backed up the long bond to 4.6 or something like that. Backed up the 10-year Treasury to 4.5, so more exacerbation of losses there in the Treasury holdings. And then will there be this lag through from the tightening of policy? The 550 basis points that we got out of the Fed thus far seems to maybe even point to further net tightening in the Fed's senior loan officer survey. And that has been in a state of tightening. I don't think people fully realize this, since the fourth quarter of 21. That's 2 years ago at this point. And so that should be something that filters through into overall delinquencies at the consumer and business level. Auto delinquencies, maybe people late on their mortgages. It's going to be something we have to slog through in 24.
You've also watched U.S. dollar strength, in particular, versus the Japanese yen and its influence on inflation. What are you seeing there?
Well, dollar yen, that's a WisdomTree thing. We look at that every day. And look at the question that needs to be, well, go to Kashkari. I mean, talking about inflation and whether we can get that under control in the United States, go back down to 2%, all these question marks that overhang on the market. Some of these other economies will have to contend with the fact that their currencies are decidedly weaker relative to the main currency. I mean, the yen, as you pointed out here, I think it was March of 21, the yen was at 103. Now I have to see in today's session, 149, 148, something like that relative to the dollar. So that is something that the Japanese will have to contend with. It makes them very competitive. It's what we've been talking about extensively due to our exposure to Japanese equities at WisdomTree. But it could be something that ends up being a sweet spot on U.S. inflation because the dollar is just so darn strong.
Do you think the Japanese equity story is still in place? Are you still bullish, constructive on the Nikkei 225?
Well, yes, and decidedly so. And one of the things that because people see the stuff over there on Twitter with the housing and all my concerns where we have a 7.51 on a conforming mortgage in the United States, which seems to me, absolutely spell home price deflation. I say, well, at the same time, I mean, well, what do you like, Weniger? Well, you have to look at some of the catalysts going on over in Japan right now. They essentially have, if you think about kind of like a concept like a traditional IRA, the NISA program, they're going to let you triple your contributions in January 24. So that could be something that catalyzes retail activity into the stock market. They're attempting from on high to try to get, and Paul, this has been the situation in Japan for your entire career, for my entire career, the savings culture as opposed to the equity culture, the perpetual anvil on the shoulders of Japanese equities for so long. If they can get that shift, and maybe the NISA program contribution max out change will help foster that. That can be something that can catalyze a little bit more, I mean, definitely more bullishness in the Japanese broad market